3, 2, 1, get it.
Good evening everyone, and thank you for joining us on this session today. I'm Divya Menon, your host for today's session, and with me I have Mr. Sivakumar. He heads the alternates, products and strategy at Axis AMC. He comes with over 25 years of experience in the Indian asset management industry, and he has been associated with Axis AMC since its inception in 2009. So with that quick introduction, Shiva will start this session, but before we get on to the main agenda, let's have your quick take on the market outlooks, both equity and fixed.
Thank you everybody, thank you Divya. Yeah, it's a very interesting day that we are choosing to do this, because today we've just had the RBI monetary policy. The RBI has of course held rates largely as expected, but on the bonus side they've cut the CRR to infuse liquidity into the system. Why have they done that? The chief trigger is the fact that there has been some evidence of slowdown in the economy. We've had a much weaker than expected sub 6% GDP print. Various sectors of the economy, many companies have reported worse than expected results. This is not to say that the economy is in a bad patch. It's just a cyclical softness in an otherwise strong growth that we are seeing. The markets also in the recent past have seen a lot of volatility and have seen some reasonable correction, especially in October where we saw a pretty large fall. November, much more of a flat one. What this correction has done is taken off some of that extreme valuation that we saw. And even though growth outlook still remains reasonably strong, valuations have corrected meaningfully. So that gives us a lot of comfort in terms of looking at a medium to longer term view to own stocks. Pockets of overvaluation still exist, we believe, in mid caps and small caps, and therefore investing has to be still taken with a clear bottom-up approach to make sure that you're buying the right stocks at the right price and the right amount. So it's still there, it's a stock pickers market, but the good news is that some of the froth has been taken out. On the fixed income side, we just saw the RBI essentially guiding for easier liquidity, cutting the CRR, and short-term yields in the markets have corrected, have come up by a few basis points in response. It's very, very likely that the RBI's next move is to cut interest rates. And with that view, I think at least in the near term, the view on fixed income continues to be reasonably constructive. It's a trading market. It's not that we are going to see a large correction in yields, but certainly we can expect some rate cuts and therefore some softening going forward. And that's an opportunity that we intend to play across our fixed income portfolios. So yeah, interesting times. I think there's opportunities on both debt and equity, different time horizons, but that's what makes those markets different.
Okay, thank you so much, Shiva. So interesting times, definitely. We'll get on to an interesting product also. So the whole session is around arbitrage funds, and before we begin with our session, I would like to request viewers to post their queries. We've already started receiving a few. So Shiva, before we get on to queries, let's get a brief about what is exactly arbitrage and what are arbitrage funds.
Good. Let's get the basics right first.
Yes.
Arbitrage essentially happens because of mispricing or difference in pricing across different types of securities. For example, you have futures and options and direct cash market stocks. There's a difference in price between futures and cash, which means that if you buy a stock in cash and sell the same stock in futures, you earn a small spread. And that spread changes across different types of stocks and different periods of time. If you are able to actively manage a portfolio of such stocks and short positions in futures, what you essentially get is, well, you don't get equity market risk because you're buying stocks and selling the same stock futures. But what you earn is the carry between the two, and that's really what arbitrage funds are all about. They essentially buy stocks and sell the same quantity in futures to balance out the market risk and just earn the carry. That's exactly what we do in the Axis Arbitrage Fund, and across the industry, by and large, that's the same strategy that is applied.
So this is what we call as market neutral approach or a completely hedged portfolio. So we have already started receiving few questions, Shiva, and given the interesting times that we are in, so quite a few are focused towards, How are these arbitrage funds going to behave across different market cycles? This is especially coming from equity market cycle perspective. How will it be in a bullish market cycle, bearish market cycle? When should you look at investing?
Good questions. As you rightly said, arbitrage is market neutral, which means we are not taking a directional view on stocks. Now, there are two ways to achieve market neutrality. You can buy certain stocks and short certain other stocks, but effectively you are still carrying market risk, in the sense the shorted stocks are different from the stocks that you are buying in cash market. But in arbitrage funds, we are exactly market neutral. That is to say, we are buying and selling the same stock. It's just that one is in cash market and the selling is in futures. That means you're not really dependent on where in the equity market cycle you are. But the spread between the cash and the futures price does to some extent depend on where we are on the equity market cycle. Because very often when you have very frothy, bubbly markets and people are very optimistic, leverage in the system tends to increase, and there is more of, shall we say, participation through futures, through options, etc. In a sense, there's larger participation in derivatives. And that tends to increase the spread between the cash and the futures market. So there is an indirect link between market cycles and arbitrage returns. The second aspect is where we are on the interest rate cycle, because the cost of carry, in some sense, the cost of carrying futures is also dependent on the short-term interest rates in the economy. Therefore, if interest rates in the economy are high, arbitrage returns also tend to be high.
Okay. Thank you, Shiva. So you covered the next question that I have in bits, in terms of what are the factors that impact arbitrage fund returns. So you did mention on spreads, but is there something else that we should watch out for in terms of how will it impact the returns in arbitrage category?
Yeah. So the number one factor is the spread between the futures and the spot price or the cash price, right? So that's the first and most important thing. And I already discussed a couple of factors, right? One is the froth in the market, or the sort of speculative interest, which leads to greater opportunities on the future side, right? The second is where we are on the interest rate cycle. When it comes to arbitrage funds, there's one more factor at play, which is that not 100% of the portfolio is typically invested in arbitrages. A reasonable percentage of the fund, typically between 15 to 30% of the fund, is deployed in fixed income securities, and that also gives you a little bit of opportunity to earn some excess returns if you're able to manage that portfolio well. So that from a fund perspective, you also get an extra edge in the sense of the ability of the fund managers to buy into debt securities, which can also give you a little bit of excess return, especially in today's kind of rate cut kind of scenarios, where you hope to make some excess returns if you are running a debt portfolio.
Okay, so we have a question from Mr. Himanshu here. What would you say are the top 3 benefits of arbitrage funds?
See, when we are looking at arbitrage, as I said, it's market neutral. It tends to have consistent, stable returns over a period of time, because you're not taking a view on the equity markets. So they are best compared against traditional fixed income type instruments, the likes of FDs and bonds, especially in the short term segment, right? So you need to look at arbitrage funds as a category against, let's say, traditional fixed income investments. And here 2 or 3 things really stand out for me. First, as mutual funds, no entry load, no exit load, any day transaction, right? If you are in an FD or if you are in any kind of bond, you incur some kind of cost to exit. Typically, if you are in an FD and you want to break it in between, you bought a 1-year FD and you want to exit after 3 months, you will essentially end up paying some kind of a cost, a penalty to have an early exit. So that's the first thing that makes a difference, right? In an open-ended mutual fund structure, there are no costs to exit. The liquidity is much easier because you get T+1 liquidity on all of these funds. And I would say the last and one of the very most important points is the fact that the tax treatment is very, very different. Arbitrage funds typically get treated equivalent to equity mutual funds when it comes to their treatment from capital gains perspective, and therefore the net after-tax returns can be substantially different for arbitrage funds as compared to traditional fixed income instruments.
I think with that interesting point, and it is also a critical point in terms of tax efficiency, we have an Excel with us. I would request if we could get that shared on the screen. This actually is one of the benefits that you were highlighting, Shiva. So if you could, take our viewers through this, so it will be very, very interesting for them to see how it impacts them.
Yeah, so what we've done here is we've just looked at different scenarios for investors at different tax brackets and looked at what would happen if you were to compare a traditional fixed income instrument, like for example an FD or a bond, versus an arbitrage fund with equity like capital gains tax treatment. We've looked at short-term holding periods. Typically an arbitrage fund investor would invest with 3 months, 6 months, 12 months holding periods. So we've looked at some long-term also, but let's look at short-term first. And we have also looked at different tax brackets. Now, at the outset, let me also make a point very clear. The tax advantage that you get from an arbitrage fund applies from the treatment of short-term and long-term equity capital gains. You have short-term capital gains being taxed at the rate of 20% plus applicable surcharges and cesses, and long-term capital gains at 12.5% plus applicable surcharges and cesses. This tends to be much lower for a large number of us in terms of who have tax brackets above the 20% mark. Now, of course, if your marginal tax rate is below 20% or up to 20%, arbitrage funds don't offer any advantage compared to other fixed income investments. So that's something to keep in mind. Arbitrage funds make sense if your taxable income is above the threshold where your marginal tax rate is above 20%, right? So we've taken an example here where the marginal tax rate is 30% plus applicable cesses, which brings your marginal tax rate to little over 31%. So here what happens is, if you were to look at a 6-month holding period and assume you get the same rate of return that you get in arbitrage as against a normal alternate investment, then effectively what you get is post-tax something like a 15% advantage over the traditional savings instrument. This just comes from the fact that you get a different treatment on tax on a short-term basis with respect to the equity tax treatment on ARB funds and on traditional deposits and other fixed income instruments. Now, if your tax bracket is not at 30% and your tax bracket is higher because your income is, let's say, goes to the next bracket, as an example, we can look at a tax bracket of 2 to 5 crores. Here, because of the increases in the surcharges, the marginal tax rate has gone up, and as a consequence, the value of that the capital gain treatment at 20% is significantly more. And from a returns perspective, the ARB return post-tax is 25% higher than the same pre-tax rate of return on fixed income instrument. That's a significant saving when it comes to your short-term returns. If your annual taxable income is above the 5 crore mark, which means with your surcharges and cesses, you're paying 42% plus tax rates, then essentially you're looking at something like a 33% increase in your post-tax rate of return on ARB funds compared to traditional instruments. This is all for short-term capital gains. If your holding period is beyond 1 year and you go into the long-term capital gains territory, there's an even greater increase, because you go from paying a 42% tax rate for above 5 crore taxable income to 12.5 plus surcharges, which brings you to something like just under 15% tax rate. And that means your post-tax return goes up by nearly 50% compared to fixed income. Obviously, the rates are different. So depending on where you are, short-term versus long-term, 30% tax bracket to 42% tax bracket, you could be looking at anything from a 15 to or nearly 50% increase in your post-tax rate of return in arbitrage funds as opposed to a normal, similar maturity, similar yielding debt product. Now that's a substantial saving, and I think that's the number one reason you should be looking at arbitrage funds, especially as a parking solution. Mind you, the illustrations we have shown also line up with what we think is a reasonable holding period, 3 months, 6 months, and 12 months, and so on.
So essentially, as an HNI, ultra HNI, or somebody who's falling in the tax bracket of 20% plus, it makes a lot of sense to look at arbitrage fund as an investment option. For somebody who is not paying any tax, probably they will have to gauge, whether it really makes tax efficient return for them or not. So with that, let's speak a little bit on Axis Arbitrage Fund. How do you see the fund being managed? What are the aspects of the fund? Is there anything that differentiates Axis from other AMCs?
Yeah, I think a few things come to mind automatically when it comes to how different or how like we are. In the first instance, we are all governed by the similar kind of rules, which is to say that we run hedged portfolios, we buy the cash, equities, short the futures. The differences come in terms of the ongoing management, right? How do you ensure adequate portfolio representation, diversification, managing liquidity, etc. on the one side, and then of course, as I mentioned before, there's one big differentiator, which is the non-equity part or the debt part of the portfolio. Our bias is to run highly liquid, high quality portfolios on the debt side, and that might be different across different funds. So when you're making a decision about which arbitrage fund to buy, yeah, please keep in mind that it's not just the arbitrage component, but also the debt component, which you need to keep in mind. Our preference is to run diversified portfolios both on the arbitrage side as well as on the fixed income side, and maintain a quality bias. Quality in this case meaning highly rated fixed income instruments and very, very liquid equity positions at all points of time. So I think if we continue to do that, then we can continue to deliver what we've done. The other factors do come into play: history of the fund, the longer term track record, the fund managers, the size of the fund, and so on and so forth. There are multiple ways to look at it. I urge you all to please talk to your advisors, talk to us. We'll be able to help you in many ways in terms of being able to optimize your journey there.
Yes, thank you so much, Shiva. So another question that we have is, while we have spoken a lot about arbitrage funds, what would you suggest is a suitable time investment horizon for arbitrage funds? So should it be for somebody who's looking at short-term investment horizon or long-term investment horizon? Should it be via SIP or STP?
Yeah, there are a lot of questions rolled into that one. I'll try to take all of them one by one. Horizon, and I think this is extremely important, right? We take pride in making statements about the appropriate investment horizons for most of our products, and this is no different. When you're making an arbitrage investment as a fund manager, you're typically buying stocks and selling futures. Now, as many of you know, futures typically have the short, let's say, a month to expiry. So, which means during that period, from the purchase date to expiry, there's the possible what's called a basis risk. That is, the price of the futures may move differently from the price of the stock, right? So ideally, you would want to hold across the expiry for you to kind of lock in that expected arbitrage. The arbitrage returns also do vary a little bit from month on month. So ideally, you should hold 2 or 3 such cycles for you to really get a stable and consistent return from your portfolio perspective. So the ideal holding period would at least be 3 months, but possibly 6 months and longer. For these horizons, as I said before, essentially you end up with short-term capital gains tax payment, right, which is at the rate of 20% plus surcharges and cesses. If you go beyond the 12-month mark, then you directly go into the 12.5% plus tax bracket. That's a significant saving even for many investors for short-term holding periods, right? Well, 1 year is not long. So if you are holding, for example, if you're targeting to hold a holding period, I would say look at least 6 months, but ideally 12 months plus, maybe a little longer. Remember that there is no exit load, and there are no lock-ins. So if at all you do need liquidity even before that 1 year is up, by all means, please use these funds for that same purpose. You will still be better off than buying a fixed income instrument, especially given what I mentioned before, both in terms of taxes, but also in terms of the exit, the freedom to exit when you want to without having, let's say, to break an FD, right? So for all of these reasons, I think there's a lot of value. Start with the horizon, maybe between 6 months, 12 months, a little longer, but have the flexibility to exit whenever you need the money. It's a very good solution for short-term parking. You asked a question about SIP, STP, etc., right? Yeah. And we see a lot of our investors doing exactly that, right? Using arbitrage as a way to STP into equity funds.
Correct.
So invest lump sum in ARB and do an STP into equity. So that is like doing an SIP, but if you have a lump sum in cash, instead of holding that cash in a deposit, just park it in an arbitrage fund and do an STP. And get a bonus at the end of the year, put it in arbitrage fund, SIP your way through the year into equity. Fantastic way of managing your liquid cash as well as getting deployed into markets. So ARBs are a good way to manage your manage both parts, right? Managing your liquidity as well as managing an SIP or an STP for your fund investments.
Sure. So we have a lot of traditional deposit investors viewing this, and so Mr. Shah has an interesting point he's presented. So firstly, he would like you to reiterate, how arbitrage is different versus a traditional deposit, or even for that matter, debt mutual fund. But he has a point. He says, FDs, they differentiate between genders, between age brackets, whether you are senior citizen or not. What about arbitrage funds?
Life is easy in a mutual fund. We do not make any such distinctions. The fund is the same for everybody. Which is good. I mean, basically, you get the best rate there is. You may not qualify for the best rate in a deposit because it's offered only to a specific class of depositors. But here you get the same rate which is applicable, which the market gives you essentially, right? And it's the same rate no matter who the investor is. So the mutual fund is a great leveler, and these funds are no different. Now, that's an interesting question also in terms of just going back. Well, we discussed what arbitrage is. Let's also look at how it differentiates from with respect to short-term debt, for example. How is it different from a money market fund or any other kind of short-term debt category, right? So the key difference is the type of asset, right? So your money market fund goes and buys CPs, CDs, which are commercial paper, certificates of deposit, and other short-term debt instruments as a way of investing and earning interest. An arbitrage fund doesn't earn interest; it earns a spread, right? It behaves almost like fixed income, but it is not quite, right? So the spread does vary across different equity securities on a given day or a given month. It also varies across time, right? So the spreads do go up and down, and they go up and down across, like I said before, and maybe if some of you joined late, I'll just reiterate here that a couple of key factors drive arbitrage spreads. One is the nature of speculative intensity in the market. So if there is a lot of action in F&O, then the futures prices do tend to get elevated relative to the cash market, which gives you more opportunities, or the spread increases, that gives you more opportunities. And the second is where you are in the interest rate cycle. If interest rates are higher, then typically arbitrage spreads are higher. So that is actually more of a similarity than a difference, which is to say when interest rates are higher, your money market yields are higher, and your arbitrage rolls or spreads are also higher. So in that sense, they are more similar than not. But the source from which they get the return, this is equity oriented versus money market funds which are debt oriented, and that's a very important distinction, at least in the eye of the taxman. So that's worth keeping in mind. Yeah. But to go back to the first point, no, we do not differentiate, and you get the same return irrespective of what type of investor you are.
So we have an investor, Mr. Vicky, who's joined us in between our session, and he came in when we were discussing on the spreadsheet of differences. Now he wants, so he's heard you a bit, but he feels that it sounds as if arbitrage is very complex. So in a very laymanish term, how would you explain arbitrage, and is it really a risky proposition, or is it a low risk proposition? Where in terms of say a riskometer would you put arbitrage?
It is relatively low risk. And what does relatively low risk mean? That basically you are not taking equity market exposure, right? You are buying cash equities and selling the same stock but in the futures market, right? So does it mean that it is completely zero market risk? No, it does not mean that, right? There are points in time where cash and futures market behave differently. Sometimes there is deviation in between the two. Therefore, for very short periods of time, you do see more volatility in arbitrage funds as compared to, let's say, a liquid fund or a money market fund, those kind of funds, because they are not really exposed to the equity market volatility at all. So there is obviously, you need to make this distinction. And that's one of the reasons why I was pains to point out that you need to hold across a an FNO cycle, an expiry cycle, for you to really reduce that. It still doesn't mean it's eliminated. There's a big difference. If you hold for longer, let's say 3 months to 6 months, and you've gone through 3 to 6 expiry cycles, then the impact of that individual volatility on specific stocks or specific periods of time does get evened out, and your exposure to the whims of the equity markets is that much lower. It's not completely eliminated, but it is much lower. We do not take directional equity positions, which means we are not exposed to the overall direction of the market, just the spread between cash and futures.
Okay. So we am merging questions of Mr. Nitin and Mr. Sanjay. So this is more in terms of, there's this geopolitical turmoil. In this context, how does arbitrage react to international shocks? And Mr. Nitin's question is India's VIX a healthy measure to gauge the performance of arbitrage?
Short answer on the first one is not much of a direct impact, right? So again, geopolitics, not just geopolitics, anything which affects equity markets, right, tends to affect the cash and the futures market similarly. May not be 100% the same day-on-day basis, but similarly, which means that you are not really going to see a huge impact of anything which is going on equity markets on arbitrage. It's a little bit of volatility on a day-on-day basis, but not on an expiry to expiry basis, right? So that's something to keep in mind. You're not taking equity market exposure, and therefore, while you may see day on day some movement up or down in terms of your daily returns, it's not going to be it's not going to be correlated with equity markets for sure. So that's something to keep in mind. The other point is very interesting. The other question which is very interesting is what is the correlation with things like VIX, right? Now, for those of you, I mean, many of you, I'm sure, are frequently trade in futures and options. VIX refers to the implied volatility on Nifty 50 options. Options, right, not futures. So VIX is a measure of the implied volatility on options markets in India. This is the India VIX. Of course, the VIX originated from the US, so when you say VIX, you also could refer to global markets, right? But the India VIX really represents volatility on Nifty 50. For many reasons, this does not really impact us. First of all, we are not buying options to start with, right? And second, we are not buying an index. Even if we were to replicate largely the Nifty, then we are buying individual Nifty stocks and shorting the individual Nifty futures. So we are not individual stock futures. So we are not taking any exposure to the index derivatives in this fund at all, right? So that's something also to keep in mind. So this fund actually replicating stock by stock, buying the cash and selling futures. So we are not taking any exposure to the VIX. Again, options are a great way to hedge your portfolio, but options are inherently directional. The call option, for example, if you buy a call option, you are taking a view on the market, right? The market goes up, you participate. The market goes down, well, all you lose is the premium paid, right? The put option works conversely. If the market goes down, you benefit. In futures, and especially in an arbitrage strategy where you're buying cash and selling futures, the two positions cancel out. If the market goes up, your cash value goes up, but you lose exactly the same in the loss in the futures because you're short the future. If the market goes down, the cash value of your stock goes down, but you gain exactly the same amount in the future. So we are neutral to the movement of the price of the stock, and we only make the spread between the cash and the futures. So that's something to keep in mind, right? And that we are not taking a call on the direction of the market. There is no implied view on the market at all in this fund.
Okay. So we have Mr. Patel who wants to know, how do I pick the right arbitrage fund for me? I'm a 50-year-old businessman and earn upwards of 5 crores annually. So for the first point, Shiva, I would want you to put out some pointers for them to pick the right arbitrage fund. But for the second point, I would request if we can have the screen up once again, because there are quite a few queries on really wanting to understand the tax efficiency. Can you show it again? So given the paucity of time, we could probably do.
I'll take the early question, and while we get the
Yes.
spreadsheet up, see, the differences between different arbitrage funds comes down to the individual fund policies, right? And in our case, for example, we are very strict that we do not take any market exposure at all. Certain funds might choose to use slightly imperfect hedges to give a little bit of market exposure. So that's something to keep in mind. I think most if not all funds in the industry are market neutral. But that's something to, well, if you're really taking arbitrage, then make sure you're getting arbitrage, right? That's the first point. So it's well worth looking into the fact sheet or the fund strategy statements and other, talk to the fund house if you need to get a sense of exactly what strategy is being adopted. Typically, minimum of 65% of the fund portfolio will be invested in arbitrage to qualify for the tax treatment. For a fund to qualify as an equity fund, 65% has to be in equity and similar securities, and therefore these funds will be upwards of 65% invested in ARB. That leaves up to 35% which can be invested in fixed income. And here people follow different strategies. Some people take longer duration securities, which introduce some amount of volatility to the portfolio. Some people take higher yielding, lower rated paper, and some mix. Our bias is to run relatively shorter term and higher quality, but people do take different calls. This is something you have to be comfortable with, because this introduces also some amount of difference in the different portfolios. So keep in mind that when you're making a choice across funds, what goes in the portfolio and what's the strategy is very, very important. Be comfortable with that first. The difference in performance, to be honest, between different arbitrage funds is relatively small. That makes the task difficult, but it also makes the task easy. In the sense, you don't have to chase performance in this category. What you really need to do is to be comfortable with the strategy of the fund, and that's what makes investing life a little easier here. Now, if you have the spreadsheet up, I can just walk through it one more time. For investors who are at the above 5 crore taxable income, if you invest in an FD or a similar interest-bearing, taxable interest-bearing instrument, then effectively you're paying marginal tax at a little over 42%. This is because you have the base tax rate 30% plus 37% surcharge plus your cesses of 4%. So if you add that all up, you end up at something little over 42% in marginal taxes. So to give you an example here, we just taken a 1 crore investment, and if you take a 1 crore investment and you make, let's say, a yield of just using some benchmark rates of return here, a little over 7%, then effectively your post-tax rate of return for holding a little over 1 year, your post-tax rate of return is just over 4%. So you're going from a 7% pre-tax rate of return to a 4% rate of return. If you do the same rate of return in an arbitrage fund, then you go from a 40+% tax rate to a 15% tax rate. This is because the tax long-term capital gains on your ARB fund is 12.5%, which is the same as equities, plus your surcharges and cesses. That takes you to about a 15% tax rate. So therefore your post-tax return goes to something closer to 6.5% from a pre-tax, a little over 6% from a pre-tax rate of return of about a little over 7%. So about 15% lower post-tax. Now, this is a big difference, a little over 4% versus a little over 6%. So that's nearly a 50% increase in the post-tax rate of return or the yield, and that's what the real story is. Now, if we change the holding horizon instead of 13 months to a shorter holding horizon, let's say a 6-month holding horizon, the short-term capital gains tax rate applies. So it's no longer 12.5%, but you pay 20% plus surcharges, and that takes your tax rate to closer to 24%. Even in this case, you still see a significant improvement in your outcome. The traditional deposit or fixed income investment still gives you a little over 4% compared to a little over 7% pre-tax, and your ARB fund goes from 7%, little over 7% to mid-5s, and which means that on a delta basis compared to a traditional fixed income, you are now earning about 33% more. So you come down from 49% excess return to 33% excess return. So if you can stay for a year, but if you can't stay for a year, you're still making significantly better post-tax rates of return.
On this interesting note, Shiva, we'll close our session today. I hope that you found this interesting and useful. Do reach out to us in case you have any queries. Thank you so much.
Thank you. And one last word from my side is, please talk to your advisors, talk to us, talk to your tax consultant before you make your final decision. While we are here to help you, we want to make sure that you get the best advice when you're making your investment journey. Thank you once again for joining us.
Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.